On this episode of Through the Pines, we'll discuss how to win financially in 2025, including creating a budget, pay yourself first, debt management, strategic borrowing, investing, like wealth building, understanding market trends, income diversification, skill acquisition, personal financial growth, setting clear goals, and leveraging technology. Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while sipping Mai Tais on the beach. This is Through the Pines, our advisors for this episode. We welcome back, and I love having them in studio. They are the 2023 and 2024, and we're hoping, again, for 2025, Forbes Best in-State Wealth Management Teams for Utah. Advisor Hub's fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Award. The financial advisors, Rex Baxter, Brandyn Smith, thanks so much for being here. Today, we are going to be covering how to win in 2025 financially. So we'll start off with, I guess, the basic thing, or the first thing maybe you would teach somebody, and that's have a budget, create a budget. Which one of you wants to start with that?
First, thanks for having us.
Rex is like, I don't know if I've ever done a budget. No.
Have I done a budget? What's a budget? How do you spell budget? No, we're excited to get 2025 kicked off right. Let's
Sweet.
The Pines. So we're hoping to help all of you get it started off right.
Yes.
Financially. I was talking earlier with this group, and for those of you that don't know, we're recording this on Tuesday, the 7th, I think it is. And this Friday is known as
Quitter's Day.
Quitter's Day.
Yeah.
Roughly 80% of all New Year's resolutions are dropped by this Friday.
Yeah.
So we're hoping that will not be the case for all of you out there listening financially.
That just blows. That's 10 days.
I know.
Like, is that for real? Is that like a real stat, or is that just like a social media
No,
thing,
I think it's a legit stat.
Unreal.
I mean, it's probably 90% made up, but it's
Yeah, like all of our lovely stats are, but yeah.
Yeah, no, I think it's great. I think as we get into 2025, I think the first thing that people should be doing is maybe making a list of what worked really well for them last year in 2024 and what didn't work so well for them financially last year in 2024, and just take an accounting a little bit of what worked, what didn't work, and why didn't it work. And then as we look forward into this next year, we can make some minor adjustments to see how we can do it better.
When you say that, what are you envisioning? Because I don't do that. Maybe I should, but what are you like envisioning? Like what financially? Is it just like in life, or
no, financially?
You do this, you like sit down. I could see you doing this.
Yeah,
sit down and like have your spreadsheet with Jenny. All right, Jenny.
Well, so I don't sit.
Here's
down with
what
Jenny,
went well.
Jenny won't sit down with me, but I'll sit down and make like a T, right? Like the old T pros and cons list, right? Yeah. But instead of pros and cons, it's good and bad. And so I'll sit there and I'll be like, oh my gosh, we ate out way too much, right? That was bad. And oh yeah, we maxed out our 401k, throughout the year, and our catch up and all of that. And that was really good. And so why was I able to do this? Well, because it was automatic, right? Yeah, right. And why did we, drop out on the eating out or whatever the negative was? And it might be because it wasn't automatic, or we just kind of lost focus a little bit and got caught up in life and the busyness of life. And so we ate out more. And so we need to make it a more conscious effort and decision, and kind of redouble the efforts for the next year, whatever that is for your weaknesses. But I think it's, if you can do that and you start seeing a pattern of these things that are working really well for you, chances are it's because it's either automatic or because you're hyper-focused on it. And so that should be an insight into your own personality as to, okay, these things that aren't working really well, how can I tweak that a little bit to make that a little more automatic, or to make that a little more focused?
And it feels good. Feels good to get the win, because I don't do that. I like the T chart. I'll run through my own personal financial plan, and I like to compare net worth today versus and end of year is a little bit slower for us, at the very end. And so anyway, I ran through that, and ran the highlights down to Jess. Hey, look, and that's about all she wants to hear. But I do like the wins of that, right? And looking and saying, all right, where did my net worth grow? What did well? What didn't do well? And you're right. I totally agree. It's making it automatic that accounted for most of it, right? The monthly savings that just happens without thinking. That made up most of that growth.
Well, when it's not automatic, that's when I think a budget would be good, right? And then it's a new year. It's a good time to maybe implement some changes even though it's the 7th today, but you can still implement the changes. How do you do that to your budget? How do you make changes when you're so used to doing something else? It's like, how do I dial back on, for instance, just this morning, my wife says, I can't buy things for the kids every time they ask. And they've gotten into this habit where it's like, Mom, hey, I need this, and Mom, hey, I need that. And then she goes and buys it, and she's like, I'm not doing that anymore. We're spending too much money by doing that.
Yeah. I think on the budget, we like to do a reverse budget is how we like to do our budgeting for the most part. And so we like to kind of back into our savings first, pay us first, right? And whether that's in the 401k or the IRAs or our personal savings, whatever it is. And so we kind of exit that out first and make that automatic. And obviously we've got the taxes that come out of our paycheck before we even see it, typically. And so we do that. And then what's left is life, right? You've got whatever bills you have and your food and gas and all these, little kid emergencies.
A lot of kid emergencies.
Right? that get piled up. But because everything else has already been done, the rest of that can be spent.
And it's hard because it's like when you say emergencies, you know what an emergency is? When you pick your kids up from dance or soccer and it's 7:30 at night and you're tired and you just want to go to McDonald's instead of fixing the food that you've already got at home. And then you do that, and then you do that again, and you do it again, and you do it again, and and it just adds up all the time. It's little stuff like that.
It is one of the tricks one of our families used when they had little kids was they would have just like a grocery shopping list on the fridge, right? Mm-hmm. They would have another list that the kids could go and write down what they felt like they needed on the fridge, and then as that kind of built up once a month or twice a month, the parents would sit down and go through it with them and say, okay, do we really need this, or is this just something you want? And now, because a week or two has passed by, that urgency has now passed, right? And it's not an emergency, and so now they can think about it and talk about it and have that discussion with the kids. That's a good learning opportunity of needs and wants, and do we really need it, and would we rather buy that, or as a family we really want to go on this vacation in the summer, would you rather we set that aside, maybe we have a little extra money for you to spend on that vacation in this other account, and thus kind of trying to reward delayed satisfaction for those kids. And so that's one of the things I saw that one of our families does for those kind of emergency things that works really, really well.
I think another thing you can do that we're trying to implement, because I don't know, I want to go on, I love the ocean, I want to go to Belize, Rex inspired me with that. And
so much fun.
I love snorkeling. And so, but it's so easy to fall into life where you're just like, what, another paddleboard? That would be fun too, And so how do you keep your goals focused? And one thing I did is just set up an automatic draw out of my checking account, right? So once you get paid, an automatic draw into an investment account so that it's like out of sight, out of mind. And if I can just maintain that, right, and if I can maintain my savings, which I think we can do while maintaining that draw, then that'll build up enough to cover that vacation cost, or two for the year. And I think that helps a lot, because I like to look at our savings account levels, right? I add up all of our banking assets and I say, all right, where are we at? And I like to track that over time, because it's got its peaks and its valleys, right, every month. And so that's an easy thing for me to track, and so I can keep my focus on the banking accounts and know that my other goals, retirement and vacation, are going to get hit, as long as I can just keep savings in that range that I want.
All right, next up is debts, and we probably shouldn't have high interest debts, but I'm sure as financial advisors you see clients that do. So how do we avoid high interest debt and high interest consumer debts like credit cards that can hinder wealth accumulation.
You mean right after Christmas? People might
right after Christmas, we may have some of those.
Debt.
Yeah.
This is probably the perfect time to talk about that.
Yeah. In fact, I just found, I have a thing, and I have to absolutely take care of it. This is the third year in a row that I bought an app for a website. It's a calendar app, but it charges me annually, and it's $300, $350 or something like that. Okay. On my credit card that they're no longer around. I can't stop I can't stop it. The only way to stop it is to call my bank and have them. And
Right.
I'm like, tomorrow I got to call this bank. I got to make sure this is the third year now that I've been surprised at the end of the year when it just auto charges and there's no company around or anything for me to even. So it's stuff like that is super annoying, especially on a high interest thing, because it's like it's almost like a ticket that you get when you're speeding or something. It's like I hate paying these things, and this stuff shouldn't happen, So that's maybe different than what we're going to talk about, but that can add on to an already bad situation on a credit card for sure.
But good for you for catching it, right? And I think that's a lot of people don't catch it. And I think the best way to catch it is to go through. I know, like, my wife will go through every line item expense, which just makes her feel good. And I enjoy it too, obviously. But she'll go through and look, all right, where did all these things come out? And we catch stuff all the time, right? That our kids like sign up for some, music subscription. Or like, what? Like, no wonder you were enjoying that, but it wasn't free, And so I think kind of reviewing the budget and reviewing where all those expenses, if you can do that, I mean, that's what I've found to work the best for budgeting. I know some people like to plan out every expense for the month, but it just seems impossible to predict what is going to happen, So anyway.
Rex, you don't use cards at all, do you? Really?
No, not really. Yeah. I mean, I use my debit card from my checking
that
account.
Does not count.
Does that count?
No.
I exclusively put everything on my credit card.
Right. You guys are opposites that way.
Yeah.
Yeah. But I have yet to pay a penny in interest, right, to the credit. And I make really good, like, I don't trust them either. So I review the statement, okay, no interest paid. But then we get a check at the end of each year, a fairly good check for using the credit card. And as long as you have it, and we just have it automatically set to pull out of the checking account every month, right?
So you pay it off every month before it collects interest, and they still give you all the points. Yeah, every last point. And you just have it set automatically so that it just pulls from the and so we just put all of our expenses. It is a little bit harder to it was hard, maybe a little bit annoying at first, right? Where I was like, where is everything? Because I've got a balance over here and it's going to come here and I haven't seen it pull out of here. And so there's this weird delay on it. But man, it's worth getting a check at the end of the year for that. That Rex doesn't live that life, I don't think.
I think everybody's just different, right? Yeah. You just need to know yourself and what's going to work for you and what you can do. And just for me and my family, it's just we've proven to ourselves that we struggle with that.
So, fair. Fair.
I think, and so just know yourself and know what works.
Okay. All right. The third best way to win in financially in 2025 is to learn investment and wealth building, investing in assets, and diversify into assets that appreciate over time or generate income, such as stocks, real estate, cryptocurrencies, or even personal development through education. Rex, what do you say about? I mean, this is what you guys do. This is what you know. But these last two are interesting to me. And then I got this list off of a very public site. And so cryptocurrencies and personal education.
Well, those are diametrically opposed, aren't they?
I don't know.
So
I don't know.
I think it's smart to be educated about the kinds of things that you invest in.
Yeah.
Right. And obviously we don't deal in cryptocurrencies, things like that. They're not regulated yet. When they become regulated, then we'll, evaluate them at that point in time. But there are a lot of people that do. And so I think you should make sure that you're highly educated about what they are, how they work, if you're going to entertain that thing. I think one of the goals that people might want to embrace this year is just increasing their financial knowledge. Mm-hmm. Whether that's reading a book like the Richest Man in Babylon or The Millionaire Next Door or one of your favorites, Think and Grow Rich.
I didn't bring
your favorites.
Psychology of Money with us today.
Love the Psychology of Money.
Awesome.
Yeah, and so there's a lot of them out there, and so maybe you just pick a book and decide to embrace it and jot down the jargon that doesn't make sense to you and ask your financial advisor. Yeah. Say, what does this mean? How does it work? And how do we encompass this and utilize the resources around you?
Those have been some of the best conversations I've had with clients is when they come to me and say, I've been reading about this, or I watched a video about this, right? Like, it's so fun because they're already primed. They've already kind of gotten into it. They understand. And then we can have a really meaningful discussion about, whatever it is that they bring up. And so I enjoy, those are some of my favorite conversations.
So that, yes, but then also, people learn everything from the internet. So do they think when you meet with them that they know everything already from the internet? Or
the vast majority of people don't think that.
Okay.
I do think that every now and then there are certain personality types that think that.
Yeah.
But generally, once you start to have a conversation, you can.
Well, I saw on NerdWallet.
You can dissect that pretty quick.
But even those are good, right? Like, it's really good for people to understand what is out there, and why we're doing what we're doing and why we're not doing other things. The more you know about that, the more confidence you have that you're not going to wake up one day and be like, oh, I should have been doing this all along, and to be able to understand the pros and cons of the options out there makes you feel so much better financially.
Yeah.
Probably one of the greatest resources to get your financial information.
Through the Pines.
Planwithbaxter.com.
Yeah, both.
Through
the Pines podcast.
We both had the right answer, Brandon.
Yes, I'm going to say yes.
Non-biased.
And then Rex and I are X-Gen, Brandon. You are not. Have you noticed your generation with getting more information from social media and the internet, or they really a difference? Is there a difference at all?
Most of my clients are closer to retirement in their 50s and 60s.
There's that, yeah.
But I do have some, and I've got friends, that will reach out and that some are clients, and definitely have most of them have done some reading and research a little bit, but they're also very open to understanding. All right, what I think we all understand that a different picture can be painted on social media or the internet.
Yeah.
That maybe isn't holistic.
Yeah, it's been around long enough now. We all get it.
Right, and so most people my age that I work with really want to run something by me and say, hey, does this make sense? Yeah. And sometimes it does, and then sometimes it doesn't. And they're really good conversations to have.
I think that one of the difficult things is that a lot of times it comes through, whether it's social media, whether it's the internet, whether it's AI with like ChatGPT and things like that. A lot of times it comes through as absolutes. Even some of the other radio show hosts, right? When they sit there and give you advice, a lot of times it comes through as an absolute that it's good for everybody. And if you've listened to any of our podcasts, there's a slight chance you've heard us say it depends.
Yeah, oh yeah.
And most things it does depend.
It's our tagline now.
I think so.
Through the Pines, it depends.
That's a good one.
Let's run with it.
Because you use it so often.
Yeah.
And so what you're saying is every situation is a little different.
It is.
Yeah. Okay. And every person is different. And so every person, so there's rules, there's financial rules, but then once you know the rules, how do you apply it to you and your personality?
Right. And does it make sense for you and your family and your financial position and your goals, where you're trying to go? And that's where you need that advice and guidance.
Okay, good. Income diversification. And I like this one the most probably of the whole list because I really didn't grow up thinking that this was what you should do. You should have one job and that was it. And or one form of income, but multiple income streams. Develop or maintain more than one source of income. This could include side businesses, freelance work, or passive income from investments, which I love those Instagram accounts. There's a few Instagram accounts that I follow, and you can follow us on Through the Pines, by the way, because I follow them through the Pines account. And they're people that essentially monthly will put out their statements and how much they made through different passive things. What passive, way, but mostly investments and stuff, and small businesses that they do a little bit of work on, but it's not their full-time job. And I find those fascinating. So Rex, what do you have to say about this income diversification?
I think it's good.
Stop.
Let's have a debate. I think it's bad.
I think
really?
passive income is a little bit of a fallacy. I think that there's not really a thing such as passive income. People talk about rental properties or Airbnbs or VRBOs as passive income. You still need to pay attention to it. You need to pay attention to who the property manager is. You need to pay attention to the property, the repairs, dividends on the stocks. Do you still want to own that stock? Do you not want to own the stock? What's going on with the company? Does it fit into the rest of your portfolio? There's still work that needs to be done on all the different types of income.
So passive is always in quotes. Like
it is
passive.
air quotes.
Air quotes.
Social Security is pretty passive.
Oh my gosh, I worked my guts out for my entire life for Social
No,
Security.
that's true.
Didn't feel
That's
very
true.
passive.
But once it's going, there's
like,
not a lot
that's the worst
to do.
return ever.
Yeah, but once it's going, you can't really change a lot. So I would argue in retirement, yes, I love financial plans where we've got some, real estate investment income, we've got Social Security, we have a pension, and we have an investment account. Those plans feel so good, right? Like the diversity on them. If Social Security starts to waver, then we're good. If markets, it just feels really good to have that diversity. And I agree with that in retirement. But we see a lot of times people, in their working years and their wealth accumulation years, thinking that, hey, if I can just get another stream of income, that's better, and I'm going to diversify and get a bunch of different, and yeah, I might be full-time accountant, but I've also been looking at doing like snow shacks in the summer, and I can run those with a bunch, and I'm also looking at this, and you go through and you diversify your income. The problem is you lose the specialization, and the margins typically are found in the highly specialized niche areas of business. And so when you broaden out and you become good at everything and effectively a master at nothing, then you lose your margin pricing power and you end up working really, really hard at a lot of areas and not making as much money. Whereas if you focus in on one thing, get really, really, really good at one thing, and you have that niche and you have that almost monopoly pricing power, you have more ability to make more money with the same amount of hours.
Yeah.
I couldn't agree more. I think that early in a lot of financial advisors at a lot of firms, not a lot of firms, but there's a couple of firms where they'll let the financial advisor start part-time, right? And they'll try and work them into an office or something like that. And so they're trying to do financial advising part-time, and then they're trying to do some other source of income because they have to pay the bills because the financial advising isn't paying the bills, and they go back and forth. And whereas had they just had tunnel vision on one or the other, they would have become probably wildly successful at one of those two areas. But because their attention, their brain power was spread across a lot of different areas, then they all suffered. And so I am a big fan of, especially during the accumulation years, of do something and do it really, really well. Become an expert at it. Become the best at it. And that way you can start to demand your own price. You can start to command your own pricing power and eventually set your own income stream, whether you're setting up a business for whatever that is that you're really, really good at, whether you're moving into a really highly specialized area within your field, whatever that is. But all of those, because there's so few people that are willing to pay that price and do that typically that's where you're going to see the higher incomes and more wealth created along those lines. But I do like diversification of income in retirement. I agree with you. And so sometimes, later in your career, as you be right before retirement, or that 5 years or 10 years, you need to start at least studying and learning and deciding which ways that might make sense, or if it makes sense at all for you.
Yeah. One, and this might be a side tangent, but I remember studying some of the upper level economic classes in college. It's in economic theory and in some of the formulas you use, you can calculate that a monopoly pricing model is more profitable than a competitive pricing model. And hence why, in the United States, we have actual models set up to prevent monopolies from occurring. Because if you can have a monopoly, you can actually charge a lot more. you get fewer customers, you'll lose some customers, but the way that formula works 9 times out of 10 is you actually walk away with a lot more money. And so that's why we're always trying to break up monopolies and not let those happen. But then as I've been thinking about this in business, that is why people try and differentiate themselves, right? If you've got a cinnamon roll business, you try to differentiate yourself from your competition, which then allows you to charge a monopoly pricing. If you have, if you can become that specialist that you can't get anywhere else, and we've all seen that from in various industries, right? This is the guy to go to or the girl to go to that they know what they're doing and they're better than everybody else. You're going to get that select few that will pay that higher price. You get the higher margins, and that's where the profitability in business usually is found.
Okay. Brandon, do you have some more numbers for us?
I do. You didn't look like you enjoyed the economic model. That's all right.
No, that was...
I kind of got that like glazed over look that sometimes my wife gives me after I'm like woohoo!
Wow.
But that's all right.
I see where your wife's coming from. No, that was... I think that answer surprised me from you guys because, I'm if you live on the internet space or whatever, they're on the Instagrams and X's and they're all diversify your income, diversify your income, diversify your income. And I think that's referring to people who they have a job that maybe they don't love. And so, but it makes good income and they want to figure out how to have more money to invest or to get out of maybe the place that they're in. So they need to go learn a skill that they would rather transfer into or something and diversify you diversify the income. So you're making more money, you can invest more. And then hopefully maybe you can leave the current position just for something better or something. I'm not sure.
But that's the question, right? Is do you spend time doing that or do you spend time if you're stuck in a career or a job that you're not really enthralled with and you don't really enjoy and you get what matter of fact, we're reading a book now, right? The 6 Types of a Working Genius. He calls it the Sunday blues, right? Where you wake up Sunday and you don't want to go to work on Monday and you're not really
that's a real
job.
For real
it's a real thing,
yeah.
Right? And so if that's you, the question becomes, do I try and spend time, energy, and effort on diversifying my income stream, or do I spend time, energy, and effort on exploring something that I'm extremely passionate about and finding a career path that includes that? Because then you're going to be wildly successful, more likely than not, if you can find something that you're wildly passionate about and it can make money.
Yeah.
It may take some time to get you there. You may have to start low and slowly work your way into it. But over time, if you play a little bit of a long game, chances are you're going to end up significantly ahead of that, as opposed to spending the time, effort, and energy of chasing down something that's viewed as passive, which probably really is not passive.
Yeah. Like podcasting, for instance.
All right, some more numbers.
More numbers.
So
I didn't mean to give you that look, Brandon. But
no, I should have got. I was just.
The conversation did go a direction that I wasn't expecting. So when I heard that, I'm thinking, I'm like, oh, that's interesting. Yeah.
Yeah.
That's what your wife is doing too. She's like, oh, that's
probably it.
Yeah.
Thank you for pointing that out. No, she's always so nice to listen. So a little bit of background on this. The S&P 500 is an index of stocks, meaning, people want to know, what did the stock market do today? How do you define that, right? With thousands of different stocks, and so one way that that's done is the S&P 500 is 500 of the largest U.S. stocks. And so they put those in kind of a basket and they say, how did those 500 do today? And that's what people talk about, or the Dow Jones, right, is a different grouping of stocks. But the S&P 500 is what we call cap rate or cap weighted, which means if you have one stock that's worth $500 per share and one stock that's worth $50 per share, they don't equalize the value, so you have an equal value of each of those stocks. The stock that's worth more has a larger weighting in the S&P 500 than the other, and a lot of people don't realize that. But that is a key thing to keep in your mind, right? Because the S&P 500 can shift its weighting, and so the Smore Numbers actually goes into that today. This is actually done by a stat from Bloomberg. that the healthcare sector had the second largest weighting of any sector in the S&P 500 at the end of 2022. They had a weighting of 15.9% of the overall sector. Then you fast forward to November of 24, and healthcare's weighting had dropped to 10.36%, which might not sound like a lot, but that's over 5% drop in the sector weighting. And that's one thing Rex and I are watching really closely is like tech, for example, right? As you see these tech companies explode in growth, now all of a sudden your portfolio has gone from more of a balanced portfolio to maybe more of a tech portfolio. Well, is that a good thing or a bad thing? I don't know, right? It depends. It depends on what you're willing to accept risk-wise and what we anticipate in the world and what ratios like price earnings ratios are looking like. But it's one thing that is very important to kind of keep in mind.
And that's, you guys do some rebalancing often.
Yeah,
I hear.
We do. Yeah, we try to. I think that's an important lesson for people to learn as far as capital weighted versus equal weighted S&P 500 returns. Again, the capital weighted, when we get into a market like last year to where we consider what's called a really narrow market. And when you hear us say it's a really narrow market, because all of a sudden narrow turned into a financial jargon word, but a narrow market means that maybe those top 7 of the 500 companies are making up 80% of the return that you're seeing on the S&P 500.
That's what happened last year, right?
And so, so last year, and I don't know exactly, right, whether it was 7 companies or 6 or 8, but
I thought there was a name for them too.
The Magnificent Seven.
Yeah, there you go.
Is what a lot of people
so
like.
It was
Thanks,
a really
NVIDIA.
narrow market.
Okay.
And that can create additional significant risk, because if you're investing heavily into the S&P 500 or into those 7 companies, and because they're expanding so rapidly, is if they end up taking a tumble at some point, you may be taking significantly more risk than you recognize in your overall portfolio. And that's why we rebalance. That's why we look at the things that we look at. But I think as individuals and clients and customers that are out there, as you're listening to these podcasts, you want to be able to evaluate your portfolio with your advisor and look at that and say, okay, how exposed am I to these different sectors? And just because they benchmark you against a static index like the S&P 500 doesn't necessarily mean that if you're in par with it today, doesn't mean that you're the same risk as if you were in par with it 3 years ago. Because 3 years ago, it may have been a very broad market.
Yeah, completely different benchmark.
Right.
So now the thing you're tracking your portfolio on is changing, which doesn't necessarily mean it's bad, but you need to stay on top of it.
Okay, well, diving back into the ways we can win in 2025, this next one, and I'm assuming this is every year, but preparing for economic changes. So, but it just does say be policy savvy. With upcoming changes like potential tax reforms or economic policies, adjust your financial strategies accordingly. For instance, if there are any anticipated tax cuts, consider how this might affect your investment and saving strategies, Brandon.
Yeah, we've been talking about that a lot, where we knew that Trump tax cuts were going to sunset and still are scheduled to sunset here at the end of this year. And so, we've been positioning for that. And then all of a sudden with this most recent election, it looks like, hey, there's a really good chance those get extended. And so, yeah, it's always a moving target, which is kind of the fun game you play when you go to a 401k enrollment meeting, right? And you're dealing with people in their 30s and you're like, all right, well, what are taxes going to be, 40 years from now? It's almost impossible to predict, but we can look at, hey, where are you at today? What's your tax rate today? And kind of do those calculations that way. But yeah, changing policy, it changes what we're looking at with Roth conversions. It changes a lot of things. And that's just tax, right? There's a lot of different, because not only do you have tax, but you have like individuals. How does political, agendas change different sectors of the market? We see that a lot. And so yeah, you're always kind of trying to stay on top of that.
Yeah. Rex?
I think that there could be some political changes this year, some policy changes this year, some economic changes this year.
And do big portfolio managers change what they invest in based off political changes sometimes?
Some do, and some don't. And so you need to understand, what their mandate is, what their prospectus says that they need to do on those portfolios. Some will be what we call closet indexers, right? And so essentially they're just going to mirror the S&P 500 and tweak around the edges to hopefully get lucky and outperform the S&P 500. Others will have different strategies where they're following, cash flows of companies, or they're following, dividend increases, and so each manager will have their own mandate that they're trying to do. I think one of the things that our team brings to the table, I was thinking about this the other day, but when you talk about policy and political changes and the landscape, our team has been working with clients through the Reagan administration, through the first Bush.
You're that old.
Through Clinton, through the second Bush, through Obama, through the first Trump, through Biden, through the second Trump. When you're talking 8 different administrations that we've been working with clients on. We've been working through Greenspan, and Yellen, and Powell, and all the different Fed chairs over the last 50 years that we've been working with clients. And so there's a lot of intuition, a lot of knowledge that's been gained over that time period to try and navigate some of these waters that may be upcoming. Again, we can't predict the future. Nobody can. But at the same time, we're pretty good at diversifying portfolios. We're pretty good at trying to walk you through what is a possibility of happening, whether it's a high possibility or a low possibility, and what sometimes might be a 1% possibility that people get hung up on, that might be a end of world scenario, and sometimes people kind of get in their own head about those things.
Are you a fan of the Fed?
Am I a fan of the Fed?
Like meaning?
Wow, that's a loaded question.
I know, but I mean, like, we've always had the Fed for our lives, but the Fed hasn't always been there.
Right.
The Fed has not always been there. I do think that the Fed has an important role as far as trying to navigate inflation of the economy, and trying to navigate kind of pricing power of the cost of goods and services. And so I think when they stay in that realm, I think that they do a pretty good job. I think when they start to expand out of that realm and try to influence or control other areas of the financial system, then sometimes I think that's a little bit of overreach, and sometimes I think that that can have some longer term unintended consequences, which we don't, as an economy and as financial markets, I don't think that we can fully grasp or understand what those future consequences will be until they happen and it's too late.
Yeah.
And so sometimes I think that can run up and lead into a financial crisis like 2008, or run up and lead into a financial crisis like the Great Depression, or the enormous inflation impacts that we had in the mid-'80s, things like that. And so I think the concept is good, and I think some Fed committees are stronger than others.
I'll do the reporters. Some would say.
Some would say.
We would be better without a Fed, Brandon.
And I get that, right? I get that argument. But I agree with Rex. It's nice when you can be experiencing inflation that was caused from, too much spending all at once and some other things as well. But it's nice to have some levers to be able to moderate a recession, right? And if we start to see a recessionary environment, it's nice to have a group that's able to kind of stimulate that and try and override that.
Yeah.
It's nice as population changes to also be able to adjust our money supply is a really big thing. You look back when the baby boomers were all trying to buy houses and them playing with money supply back then, and it can get, it's not easy, right? The answers just aren't easy. What do you do when all of a sudden your population expands? Everybody wants to borrow money. Do you just let money get really, really expensive and just stay fixed? Or do you allow for, a Federal Reserve that's able to kind of massage that a little bit and increase the money supply? And I think there's really valid arguments on both sides of that. I think I find myself on, especially having gone through what just what the Fed just did, fighting inflation and interest rates, I think they did a really good job. It would be hard to argue they didn't do a good job.
I mean, soft landing or whatever you want to call it.
Yeah. Yeah, now
not crashing.
Now there will be plenty who will say, well, inflation's out of control, and that's true, but that was mostly, in my opinion, policy issues, right? Of extra spending and extra stimulus that was done, and then the Fed kind of cleaned that up. And so I don't know. Again, I'm comfortable that there's
this is not
valid
a Fed
arguments.
podcast, but maybe we should have one for crying out loud. That gets kind of deep in the woods there too of things we can't control necessarily, right? Like
it's one of those things you want to be aware of and you want to understand, but you can't control it. And so, what you can control is how you're invested, and you can control some of the investments that the Fed has levers that could impact, like bonds, like fixed income, cash, checking accounts, savings accounts, money markets, limits in banks, things like that the Fed has influence over. And so I think you need to be aware of it and make sure that you're paying attention so that you're not caught asleep at the wheel and all of a sudden, the Fed makes pivots and you don't, because that's trouble.
Yeah. Okay. All right. Well, we kind of already covered this next bullet point, which is personal financial growth. And Rex, you mentioned it, like read a book, anything else you guys want to discuss as far as just besides reaching out to planwithbaxter.com and into a financial planner personally, what can people do on their own to just know more about wealth building and finance?
I would love to see more families communicate with each other about it.
That's
what I would love.
Yeah. So they should gather around their local podcast fireplace and put on Through the Pines.
Yeah, I
discuss it. Yeah.
I think they really should set a goal to spend maybe 2 hours a day listening to Through the Pines.
Yeah. But so family discussions.
I think family discussions around money,
and not
around
fights.
finance, around the way that one parent was raised versus the other parent was raised, and their takeaways and what they would have done differently, or if you're nervous about that discussion, how your parents were raised, and why you've done things differently and how. But I think all of those discussions will help educate and shape that next generation if you can have that with either your kids or with your parents, either direction.
What age do you start talking financial and money lessons with your kids?
Pretty dang young.
As soon as they'll listen. I mean, so my kids are 6, 9, and 12. Right. And we talk, and obviously I don't think they understand the numbers of it very well.
Yeah.
But they understand the emotion of it.
Yeah.
Right. And they understand, like, hey, we, our camping trailer broke, and so we could have gone on a really nice vacation, which we really want to do. Or we could have bought this trailer and, a newer trailer that's going to work a little bit better. And this is why we thought about this. And this is how much it cost. And these were the pros and cons. And this is, and we'll even ask our kids sometimes, and obviously holding the right to veto, but we'll ask them, hey, what do you guys want to do for this vacation? What do you want to do this summer? And more than anything, I want them to emotionally work through making financial decisions.
Yeah.
And obviously, is my 6-year-old listening? Probably not, but
Rex.
So I don't have any stats to back this up, right?
Uh-oh.
But when I was studying for the Series 7, and I would take out the old chisel and put it, chisel my notes into stone, to say. Jenny was pregnant with our second daughter, and so I would sit there and she's pregnant and the baby's in the belly, and I'd sit there and read. So this is how much.
You would. Oh my gosh! I totally believe this. Oh,
so I don't have any proof to see whether they're financially smarter than my other kids.
But we'll see. We'll see.
So we'll see.
I mean, you should. She's old enough now.
Jury's out. We'll find out.
Well, what I did the other day, and this was a fun exercise, and it was completely statistically I overblown it for drama lessons, right? But my kid had a piggy bank and he wanted to buy something at the store. Well, he wanted to buy V-Bucks. Everyone with kids knows that this is what they buy. So we dump it all out, and he had a stack of cash and he had a ton of quarters. He had like $38 worth of quarters or something. And so they're all in a line, and it looks like a lot because every dollar, so all in a line plus the cash. And I said, okay. And I made this, I totally made it up. Total cash, he was around $100 or whatever. And I said, how much of this do you want to spend? Because everything was broke down into like $10 stacks or whatever. And I said, if you spend this $10 here, then it's gone and you don't get it back. But if you keep it here, next week I'll double it and I'll give you another $10.
No way.
And that's interest.
Yeah.
And boy, did he have to think about that, because he was like, oh, I really want those V-Bucks, but wait, I can get another stack? Like, well, you know what I mean? Like, he had to think about that.
Great
for a
life
second.
lesson, though, right?
Yeah.
I mean, that is a great life lesson to teach interest and delayed satisfaction. And boy, if you wait, you'll still have the same $100, and you can have those if you'll just wait a week.
Just wait a week. Yeah. Now, It doesn't work like that in real life necessarily, but interest is a thing, and that teaches you how to invest and not spend immediately and think about your purchases and things like that.
Absolutely.
So,
it's the concept and the habits,
yeah,
right, that we want to form for our young kids. And so we've talked about this before on previous podcasts, but lots of times, when we're going to a fair or to Disneyland or whatever, we'll give our kids a budget of what they can spend. Mm-hmm. And they have to make tough decisions of, do I want the Mickey Mouse ears, or do I want the turkey leg, right? Or whatever it is.
Or do I want to save it? I love watching their wheels turn, Right. I don't know.
Oh,
we could go on Amazon, find something a lot better than here,
Yeah.
Yeah, it's tough. But so we start that pretty young in our family as far as having those kinds of discussions. And I know our family's a little bit unique, but we're pretty open about talking about money and talking about investments and financial matters. And so we get our kids saving pretty early.
I mean, I would hope so, Rex, but you probably know financial advisors who their family doesn't talk about money much, I'm assuming.
Yeah, there's absolutely some to where it's almost taboo.
Is it?
About talking about money and dad's job or mom's job.
That's what they do all the time.
Yeah. So I don't know. It just boggles my mind.
But it's hard
There's
socially.
definitely people out there.
It's hard socially, right? Because, I also have to have that discussion with my kids. All right, but do we talk about any of this with other people? No, because it can make people feel, just, I don't know, like trying to make it normal for them to understand and talk about it, but also understand the social requirements of, we don't want to talk. It's kind of a weird world that way.
Whoa, is finance thrown in with politics and religion?
Right.
Yes.
Yes. All right, the last way to improve your financial status, or the best way to win in 2025, would be to leverage technology, use financial tools. I just think this comes back to, Brandon, something you've said multiple times over and over again, and that's automation.
Yep.
Okay.
Yep. I think establishing the goal, figuring out what your goal is, and I think working with an advisor is one of the best ways to do that. What is a reasonable goal based on your current savings, your income, and your current spending habits? Establishing that goal, figuring out what do we need to do in order to hit that goal, and then just making everything automatic. Yeah. And I think that's good long-term for retirement, and I think it's good short-term for an annual, what do we want to do for fun this year as a family? How do we make sure we've got it saved up? And so that we can, because it's just too easy to spend it when it's sitting and checking.
Yeah.
I think as we make it automatic, one of the things that a lot of you have available on your 401k plans at this point in time is automatic contribution increases.
Yeah. And
so lots of times when we're going in and meeting with employees, we want them to try and be saving, and it's different for everybody, but between 10 to 15%. And typically as a rule of thumb, this is one of those general statements, but as a rule of thumb, 10% gets you a good retirement, 15% gets you a great retirement. Obviously, depending on when you start, and there's a lot of those variables, but we want you to typically increase and get there as quickly as possible. And so we try and get people to start just a little bit higher than their comfort zone. And then if they have to tone it back, then we understand. But then the next year, they should increase it by 1% at least. And because most people won't feel a 1% difference in their paycheck.
And if you get a raise, maybe it stays about the same, your take home.
Right. It might. And so, and on raises, typically we try and get you to take half of your raise and put that into the 401k. So you're still getting a raise, but then we're getting up to that 10 to 15% a little bit quicker.
Yeah.
So if you come into the new year, you're receiving a cost of living increase or something like that, keep these strategies in mind to try and increase it by a little bit that you're putting into your retirement accounts. And if you're getting raises, then take that into consideration and try and increase just a little bit more into those accounts if you need to, if you're not at those limits anyway.
Okay. Anything else, Brandon?
No, I think that's good. I think the one other big automatic one is HSA accounts are really good, right? Because especially if you can do that through payroll, you get the FICA deduction in addition to your federal and state deduction, right? And so yeah, HSA is a great one to make automatic and just do that so that the full amount is scheduled to be paid into the account.
So many acronyms: HSA, FICA,
wow,
all these things.
Health savings
break that
account.
down first. Right? Yeah, your health savings account. If you have a high deductible health insurance plan, you can use that. You get the tax deduction up front. You can actually invest it in that usually, and get tax-free growth and pull it out tax-free if you use it for medical expenses. So HSA is one of the best investment accounts out there. But yeah, the FICA and without going into all the different taxes, it's the most tax efficient if you can do that through payroll and just hit that full amount every paycheck, have it on track to hit that full amount throughout the year. Also know that the limit is based on your contribution and your employer goes into that limit. This year, I believe it's $8,550 for a family.
Wow. Okay. Rex, Brandyn, thanks so much for being on this episode of Through the Pines. If you found value in this podcast, please subscribe to our YouTube channel at Through the Pines or follow us on Instagram at instagrams.com/pine. Well, you just go to the app, pines_podcast. Also, you can consider supporting us here at the Banyan Collective, producing the show at buymeacoffee.com/Banyan, where you just give us all your money. It's as easy as that every month. You just hand it over. We will invest it for you in the form of cheeseburgers, and
that's how Brandyn wins in 2025.
Brandyn Long.
Yeah.
No, we set up a little payment plans there, so if you would like to donate, you certainly can. This has been, thanks for listening. Also, by the way, appreciate it. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.